Hey, welcome back, IB International Economics students, to this video lecture today on the first type of Forex markets, the floating exchange rates, okay? So what is the floating exchange rates? That is when the price and value of a currency is completely determined by the foreign exchange market and the demand and supply for the particular currency, okay? So what are some determinants that may cause the Forex market to fluctuate? What are some determinants that may cause the value of a currency to increase or to decrease, okay? So right here I have five different determinants of the floating exchange rate. I have five different determinants and causes for currencies to change their values. The first one is exchange rates, interest rates. If a currency decreases their interest rates, that means that is an expansionary monetary policy or expansionary fiscal policy. By decreasing the interest rates, that is an expansionary fiscal policies. And expansionary fiscal policies will lead to a more increase in money supply in the home country's currency. Now, as we have talked about, an increase in money supply in the home country will lead to a depreciation of the country's currency in relation to other currencies. So interest rates, of course, is a major factor. Of course, fiscal policies and monetary policies are also included. That basically means increasing or decreasing the money supply of a single currency in relation to other currencies. The second one is inflation rate. Once again, there are basically two fold. So one fold is if the citizens of one country sees hyperinflation occurring, that they will want to quickly change their monies into other currencies. And that way, buying other currencies with your own currency will decrease the value of a currency even more, leading to greater depreciation of your currency, and that's negative feedback loop. However, interest rates inflation may also affect the forex market through when the home country's value decreases, foreign currencies increase in value. Okay, so if inflation is high, then your country's currency's value decreases a lot. That foreign currencies increase in value in the forex market. Now, taste of foreign goods and domestic goods is another factor and determinant of floating exchange rates. Once again, the taste for foreign goods. For example, if consumers in Japan suddenly has increased taste for American products, then they increase their demand for American products. And in order to buy American products, they have to change their money into USD, therefore devaluing the Japanese yen. Vice versa, if Japanese people have a less taste for American goods, they stop buying American goods and they stop exchanging their euros, or they stop buying American dollars from Japanese yen, then Japanese yen will increase in value. Okay, so that's the taste factor in the determinants of a floating exchange rate. Once again, these are all minor, or they could either be minor or major determinants in the floating exchange rate. So taste, once again, is also another big thing when it comes to, for example, consumers buying stuff and importing stuff from markets. Now, speculation is another major determinant of the floating exchange rates. Once again, that is buying or selling currencies with the hopes that it will go up or go down in value. The Australian dollar is actually really volatile. Just in the past year has increased in 20% in value and decreased again. So speculation in the forex market is actually quite big, especially if some investors use 5x or 6x the value of the trades. So it is indeed a very big market for speculators and investors to do in. Now, income level is the fifth determinant of floating exchange rate. What do I mean by income level? For example, if the income level in Australia increases, that means the money supply in Australia will increase. That will lead to a depreciation of the currencies abroad. Now, what are some positives or advantages and negatives or disadvantages of having a floating exchange rate system like this? The first one is relative balance in trade. Now, why is that? That's because if your currency becomes so strong, then your exports becomes less desirable, okay, and that will be balanced out. Now, if your currency becomes weaker, then your exports becomes more desirable, and once again, that balances out the trade. So, one of the advantages of having a free floating, or what we call floating exchange rate is that trade will be relatively balanced. Now, another advantage for a floating exchange rate is the central bank is free to use fiscal policies and monetary policies for the government as they wish. So once again, we have our macroeconomics objectives, sustainable growth, low unemployment, inflation to a low. Okay. these macroeconomic objectives are better reached when fiscal policies and monetary policies may be freely used by the central bank and government instead of having regulations because they need to control the forex market. So having a floating exchange rate, forex market is also really good for central banks and government, where they're able to freely use their fiscal policies and monetary policies to their wishing. Now, what are some disadvantages to freely floating exchange rates? Now, first of all, is uncertainty to investors, because, for example, what happens if your Mexican pesos quickly devalues against the US dollars? Now, that's a big, scary idea for investors, especially if American investors are setting up factories in Mexico, right? That's a scary thought. Now, having a freely floating or floating exchange rate in the forex market makes the volatility of such international trades and international trades across foreign currencies a lot more dangerous. Now, another disadvantage is imported inflation. Now, what do I mean by imported inflation? That means it's harder for your country to export goods, or it is harder for your country to export goods where your currency is strong, and it is a lot easier for your currency to import goods when other currencies are weak, okay, and your currency is strong. So this may hurt if your country is a producer or a secondary producer. For example, a manufacturing country like China, having a floating exchange rate will be quite detrimental, since they want a weak currency, and a weak currency is actually beneficial for them on the forex market. Now, these are some diagrams that illustrates the concepts, and that's pretty much it. Okay, that is the floating exchange rate in the forex market. Now, what is this once again? Appreciation and depreciation of the currency. If there's a increase in demand for US dollars, the US dollar demand curve gets shifted right, leading to dollars per euros per dollars to go up. Okay, so this is appreciation in the US dollars. Now, what happens when there is an appreciation in the US dollars? The supply of euros have to increase. So the supply of euros gets shifted to the right. That means the dollars per euro gets shifted down, a depreciation of the euros. Okay, so that's basically what happens in the forex market when such event occurs. So I hope this lecture is helpful, and I hope to see you guys in the next one. Goodbye.